Hello and welcome to the business edition of PM Express with me, Philip Nanfuri. Today we want to look at a forecast in a report that suggests certain key developments will take place in the Ghanaian economy. And this report is coming from the Economist Intelligence Unit. This report has got a lot of us talking, a lot of us discussing the way forward for the Ghanaian economy. But the report makes one telling statement, and that is not going to be our focus, but I just want to set the record straight. And it says, the next national elections are due in 2020. The Economist Intelligence Unit expects the ruling MPP to retain power as the party is seen as a better custodian of the economy than the opposition NDC. Now, thanks for staying with us. So we're going to look step by step at some key developments in this Economist, Intelligence Unit report. Focuses on Ghana and the future of our economy. Atop all this is a prediction about the elections, but that's not our focus. We want to delve into the numbers, what impacts you and I. We want to feel it in our pockets all the time. So we're going to look at that. And Professor Asibe is here to help us delve into this. Professor, thank you very much for joining us.
Thank you for having me.
So, yes, interesting report coming in from the EIU, Economist Intelligence Unit. And I'm going to jump off straight with the first key point here, and I'll read it. And it says, rising oil and gas production will continue to support real GDP growth during the forecast period, with growth averaging 5.9% a year in 2019 to 2023. Now, I ask myself this question. Our dependence on hydrocarbons to fuel economic growth, are we making a mistake in continually focusing on hydrocarbons or the oil industry to propel our economic growth, or for the time being it's right? Because if you look at what they are saying that it's going to support real GDP during the forecast period with our growth averaging 5.9% a year. Also putting at the back of our minds the rebasing also. What I've just read out to you, are you in line with this, with what you yourself study on the ground? Is this an accurate prediction to make on the Ghanaian economy?
Thank you, Philip. First of all, let me say that this is only a prediction. It's a forecast. It doesn't necessarily mean that all of that will come to pass. It depends on what the government does from now on to the time of the prediction and all the other external factors, domestic factors, and all of that. But of course, I think that the report, as it's been presented, is a good assessment of the Ghanaian economy. It gives government some positives, it gives government some negatives. And I think by and large, it's a positive caution, if I should say so, to government. And government must take a critical look at it and see areas that it can improve, where it has to devise some strategic mitigation measures to reduce the risk that is currently in the economy. So coming to your question on the energy sector, petroleum, oil and gas, I think over the years this country has depended on extractive sector. You know, even before the oil and gas came with the extractive sector, the mining and also the primary sector, including the cocoa and timber and all of that. And that has supported this economy for a long time. In fact, most of our growth can be explained by this extractive sector. And in recent times, we have the oil and gas. We do not have enough choice. That is the bedrock of this economy besides agriculture. And you know how volatile agriculture growth has been. And therefore, as it stands now, it is an additional resource for the country. What matters is how we manage the resources. Ensuring sustainability, ensuring that the greater majority of Ghanaians actually benefit from it, and ensuring that government get a big stake in the revenue that is generated from these resources. Of course, this commodity has very volatile prices in the global market, and therefore one cannot 100% depend on it. It is an additional resource that you need. You need to show up your own domestic revenue mobilization. But then you have to make sure that many of these extractive resources are non-renewable resources, which means that in the next 10, 20 years, particularly with the oil and gas, many of them would have been depleted. And therefore, as the revenue is coming in now, you have to make sure that you are setting a good chunk of it aside for a future generation, for you to be able to sustain your revenue inflows. Okay, so it is important that you do not depend solely on the revenue from this sector, because it is very volatile, it fluctuates very widely in the global market, and therefore you must always be looking within the inflows. You have to invest in the critical sectors of the economy, so which can ensure you some sustainability in terms of revenue flow. Otherwise, if you solely depend on extractive sector, you are definitely going to have your revenue projection not being stable, and also your inability to deliver on some key social amenities in the economy. So the projection that it has done, of course, it has helped this economy with the coming on board of the Jubilee, with the 10 field, with the Sankofa, and then the Arcades announcement. It's a good, it presents some good prospects for this economy, because every economy has a key revenue source. And I think that oil revenue is an additional revenue for this country. And therefore, we have to try to make the most out of it in terms of managing the revenue. Luckily, we have the Petroleum Revenue Management Act in place, which is one of the best in the sub-region or within the industry to manage the oil resources. It's in a way that we will not overspend, in a way that we will not overindulge, or people will not take advantage of the revenue inflows, and we'll be able to spend it in a way that benefit both the present and the future generation. It's key. So if we are able to adhere strictly to the Petroleum Revenue Management Act, I believe that even before these resources are run out, before they are depleted, we would have made significant gains. We would have invested in significant infrastructure to take care of the future generation. So by and large, I think their projection is quite reasonable. I mean, looking at what is happening, these projections are likely to be the case.
And Prof, just out of curiosity, when economists are making such projections, do they factor in external factors that can just hit these projections they make? Has this already been factored? Just out of curiosity, we are projecting that we're going to grow at this level with oil supporting us. What if something happens, like what's happening right now with the attack on the Saudi Arabia infrastructure, which has knocked prices upwards? What if something happens and prices go downwards? Are these external factors always factored in to such predictions?
Yes, to a large extent, these factors are taken into consideration, but there are some other factors that are unforeseen. Okay, they are contingent factors. You cannot predict, for example, what has just happened, you cannot predict. That is why it remains a forecast. And I said from the beginning that it doesn't necessarily mean that these forecasts will come to pass. Of course, this is going to drive growth in the next 2, 4, 5 years. But then given also what government is doing, if government is able to critically, substantially invest in other sectors, particularly non-oil sectors of the economy, with the industrialization drive, the 1D, 1F, and then the industrial parks and others that is actually rolling out, with the investment in agriculture, if you are able to improve agricultural productivity and improve agricultural yield, we may not necessarily have to depend on oil and gas sector to drive our growth. If we want to ensure sustainable growth over a long period of time, then these are the goalposts that we need to look at. Investing heavily, creating the enabling environment for smooth industrialization takeoff, for the private sector participation, investment in agriculture is key. And increasing yield per acre in agriculture, that is productivity, If we are able to do that, it makes it attractive for the youth to also go into agriculture along the agricultural value chain. Okay. And these present more stable income okay, its contribution to GDP is more stable, its income to individuals is more stable than relying on the extractive sector. And so for us to be able to reduce the volatility in oil and gas, because like you said, it has so much stochastic errors that it can go up, it can go down, and you can hardly predict what is going to happen to the extractive sector at any given time. And therefore, it is not prudent for economy to solely depend on this sector. You need to grow your domestic economy. The non-oil sector, which is more inclusive, it employs even more people than the extractive sector. Okay, and the income from this sector, from agriculture, from manufacturing, from other industrial sector, construction, and others are stable, you know, source of employment for the people. And it will ensure sustainability over a long period of time. Yeah.
Okay. I want to, you mentioned the one district, one factory. I want to move on to another point they make about industrialization, and we'll tie it into the banking sector issues. Now, he says the government's industrialization push and moves to strengthen the banking sector will benefit non-oil economic growth, although the cost of capital will be prohibitive for some businesses, particularly small and medium-sized enterprises. Look, I want us to get, there's a lot in here. I want us to take it one by one, starting with the industrialization drive. Some will argue that the government has done a lot when it comes to this one district, one factory, and their moves to push the industrial base of the country. Now, sitting here thinking, what can derail this our industrialization drive? What can act in a manner that will take us off a proper trajectory, if I can call it, in the industrialization drive? What can affect us right now? Because government says they want to put in some, and the private sector will also put in some. Right now, it seems the factories are coming out one after the other. Some are arguing that they are not really seeing the full effect of it. From where you sit, what can we do to, one, prop up this growth, and at the same time, what can act to slow this growth of our industrialization drive? Yes,
when I looked at the report, and the report was actually describing the effort as ambitious industrialization policy. I don't think it's ambitious at all. You know, it's always good that you dream big. That people have criticized the 1D, 1F, that the progress has been slow. But I would say that despite the slow progress, I think that it is a good policy that even if we get one industry running, it is still an additional resource. It will still have employed some people. It will still have contributed to the tax that we have. And therefore, for me, the time doesn't matter so much. So long as we are doing something and we are ensuring that every year or every month we have 1 or 2 new factories being set up, it is a good start. It's a good initiative for the economy. But the key issue for me is about the sustainability of these factories that are being set up. There's one thing setting up a factory, and there's another thing making sure that the factory thrives, it's profitable, and it is sustained over a long period of time. And therefore, government is doing something, of course, creating the enabling environment, trying to clear the bottlenecks, you know, the tax system, digitizing and all of that to create a friendly business environment for these businesses to take off. But if you look at the literature actually look at the industrial policy, and every industrial policy actually thrives on 3 key goalposts or pillars. And that is about competitiveness, it's about the capability, and it's about connectedness, okay? So you're talking about competitiveness. How competitive is this factory going to be? It's key. We need to answer that question, okay? Competitiveness in ensuring that your transaction cost is low, okay, ensuring that you are producing at a lower cost of production so that your pricing, yes, okay, you can compete both domestically and externally, you know, so that these businesses will not be confined to the domestic market. They will be able to penetrate into the global value chain, and they will make enough profit to, you know, to pay for their workers and to pay taxes and all of that. Otherwise, there's no point. Like we've seen in the past, where they set up in the next 2-3 years, you see that they have actually gone down. And for them to be competitive means that they have to have a supporting infrastructure. Okay, the supporting infrastructure, the road network has to be good so that regardless of where these firms or factories are sited, they will still be able to break even or be able to transport their their produce to the exit points without incurring so much cost that will overrun their profits. You know, the infrastructure has to be good. The environment has to be supportive. That will make them competitive. Capability. Do they have the skill set in every area of in the regions? If you are taking it to a rural district, is there the capability, skills, technology, the know-how to be able to manage these factories sustainably? We need to answer that question. What kind of technology are they deploying? Are those technologies state of the art? You know, would they be able to withstand pressures and changing conditions, market conditions? And are they versatile enough and all of that? So key management skill is key to be able to sustain these businesses. And the other issue would also be the connectedness. Okay, how connected would this be? And in connectedness, I mean the marketing aspect of it. Okay, the transportation, the marketing. Is there a market for this produce? Are they able to meet the standardization, the global standardization? Are they able to meet? Are they able to export and penetrate into the global market? All of these are very important, and so we should have an integrated strategy to manage the entire value chain of these factories that are being set up, which I think is a good thing. It's a great idea to even dream it in the first place. And so once they are coming, these supportive institutions and creating the enabling environment and regulations are key for their sustainability in that regard. Yeah.
Okay, Prof. So, Prof, if you look at what they said about the non-oil economic growth, they said moves to strengthen the banking sector will benefit non-oil economic growth, although the cost of capital will be prohibitive for some businesses, particularly the SMEs. Two key things coming there. We've had a wave of financial sector reform, particularly in the banking sector. The banking authorities argue that all these moves were meant to bolster confidence and ensure that the banking sector is strong again. If you look closely at Bank of Ghana's banking sector reports over time, you realize that banks were investing heavily in fixed income securities rather than lending. It's early days yet to tell if that has changed, but cost of credit also became an issue. Some are arguing that the Ghana reference rate is not doing enough to solve the problems. What do you have to say about what is the reality on our ground in Ghana with regards to the cost of credit, support for SMEs, and whether the banking sector is really poised enough to support economic growth?
Yes, I think the banking sector plays a crucial role in economic growth of this country because, I mean, for any growth, you definitely need the finance. It's the lubricant that often will oil the engine of growth. So without it, the engine of growth cannot move. But if it's not good, if the oil is not good, it can, you know, spoil the growth process. So you need the quality of that oil is key. And the quality here in terms of accessibility, in terms of affordability, they play a vital role in people having access to this oil, which is the finance. So I think looking at what has happened over the last 2 years or so with the banking sector cleanup, I think that for me has actually revolutionized the banking sector and the way we do banking in this country. It's a very good lesson for everybody where you have to save and whether you want to set up a bank or not and all of that. And for me, the knock-on effect has been that the banking sector now is cleaner than it used to be. Banks are now solvent. They are sound. It's well capitalized. And so if these things are the features of the banking sector, then one can only see an improvement in the credit allocations, in the supply of credit. It should reflect in interest rates coming down. It should reflect in increase in private sector credit, like I said earlier. And it should be able to generate enough growth levers in the country. So that is the expectation. As to whether these things are happening is also a different thing. When you look at the recent Bank of Ghana report on the economy, I think that we've seen some turnarounds. Okay. Credit growth has picked up. We've seen that the capital, within the banking sector, which means the banks have become more solvent. They are now well capitalized, which ensures the stability of the financial system. We've seen that banks' exposure to risk has reduced. That is, the non-performing loans have gone down. I think it's now from about 23%, is now about 18%. It's still quite elevated, though. It's still very high, 18%. But it shows some positive development in the sector. Interest rates, yes, we've seen some decline in interest rates, but I think that the decline has been slower than is expected. Because, I mean, if you look at the financial sector and the real sector, the only variable that connects the two is interest rates. Okay, if the interest rate is low, the private sector will be able to borrow and will be able to invest in their businesses, in their enterprises, and to expand, employ more people, and the economy will grow faster. So if the interest rate or the cost of credit remains high, then this relationship, is quite weakened in that regard. And I think that the interest rate revolving around 23%, 25%, when inflation is in single digit, I think the spread, the wedge between this interest lending rate and inflation rate remains too high. Yeah. You made reference to the reference rates. Yeah. Reference rate is around 16%. Yes, and once the reference rate is around 16% and treasury board rate is around 14, 15%, it is difficult for lending rates to come down. Yeah. I still believe that even that gap between the reference rate and the lending rate still is high. Often in many developed countries, the spread is not more than 500 basis points. Okay. Okay. But here in Ghana, we're talking about 800, 700 basis points. And I think that the commercial banks and even government itself, the monetary authorities, that the central bank, should work to close that gap even between the reference rate and inflation rate. Now the inflation rate is about 9.6% and the reference rate is 16%, right? Now it gives a gap of about 700 basis points. The standard one is 500 basis points. So although inflationary pressures remain quite high, I think that the central bank can consciously reduce that gap. That will bring the reference rate down. And then banks must also reduce the spread between the reference rate and then the lending rate. I think the spread remains too high. Okay. The reason, well, some of the reason that they give is the fact that the non-performing loan, the risk, the risk premium remains high and the operational cost remains high. But of course, I mean, from what is happening now, it's now the banking sector is sanitized now, and the non-performing loans, is improving. The ratio is going down, and therefore that justification for me does not wash now. And I think that both have to work in a way to reduce the spread so that lending rate could come down. It still remains one of the, it's very high in the West African sub-region, which will tend to stifle any growth efforts that we are making. The private sector will not be able to respond to many of the fine policies of government, the interventions, and that could slow growth significantly. Okay.
This is the business edition of PM Express with me, Philip Nanfuri, my guest, Professor Eric Osei-Asibe. We're taking a quick break. When we get back, we're going to delve into the Ghana cedi. They are predicting some significant depreciation in the next 3 to 4 years for the Ghana cedi. Can you imagine getting it at 6 cedis, 47 pesos? Very high. This is the business edition. We'll be right back. Thanks for your company, and this is the business edition of PM Express with me, Philip Nanfuri. Before I went on the break, I just gave you a bit of a teaser about the CD and then largely the exchange rate, let me call it that. And let me just pick this for you. It says, the CD will remain prone to periods of volatility, given the country's exposure to movements in commodity prices. From an average of 4.58 Ghana cedis to $1 in 2018, the currency will weaken to 6 Ghana cedis, 47 pesos, to $1 in 2023. Prof, this year alone, at the beginning of the year, the first quarter, we experienced significant depreciation. The explanation from the authorities was that we had to hold our reserves to meet some IMF prior actions, etc., and coupled with the normal seasonal demands from the market. Now, they are telling us that we are going to experience periods of volatility given our exposure to commodity prices, one of which is the oil we just discussed, and that the currency will weaken to 6 cedis, 47 pesos in 2023. Is this an accurate picture?
Here again, I want to say that it's a prediction, but it's a possibility. It is a possibility if nothing is done, to mitigate the risk of the cedi depreciation. Of course, once we are under a floating exchange rate regime, it's always difficult for the central bank to hold down or to pin down the currency. What the central bank can do is to try to meet it some halfway to not to allow it to depreciate so fast. The stability of the exchange rate is vital for any macroeconomic stability. I mean, if you want to achieve stability in macroeconomic sense, be it fiscal, be it your growth and whatever, if you don't have a stable exchange rate, it is difficult for you to have. With fiscal, if your currency depreciates, definitely it's going to affect your fiscal projections because it's going to lead to a widened fiscal deficit because your interest service will go up. It's going to increase your debt stock because a greater proportion, a vast majority of your composition of your loan or your debt is in external currency. And therefore, when you convert that into the local currency, you see much more debt obligation. And therefore, you need to be able to hold that. In the domestic market, when the currency depreciates, it affects the domestic consumption because imported prices will go up. It affects transportation. It affects grocery products. And so the general price level would likely increase, which means that your inflation would go up. And once your inflation is going up under the inflation targeting framework, it will mean that your interest rates will go up and your lending rates go up, and it comes to stifle the growth drivers of the economy. So it is one key macroeconomic variable that it tends to explain so much of our macroeconomic stability. And so I think that what the Economic Intelligence Unit have said is something that the central bank should not take it lightly. Of course, even when the projection is quite conservative, if you ask me, because we are talking about 4-year period. And so if 4-year period, we have been able to hold it to just about 6, 6 cedis, 43 pesos. Compared to the previous 4 years, then you could see that the management of the cedi is much better. Okay, so far, I think so far so good. Over the last couple of months, we haven't experienced that rapid depreciation as we have we've done. To hold the cedi will require very drastic measures. One is more long-term measure, like what we often say that we have to do more in terms of increasing our exports revenue. We have to diversify exports. Diversifying means that we are able to increase our export revenue away from the traditional export, which often is very volatile. We are able to increase export value by adding value, to our primary exports. And by so doing, it will increase the inflows of foreign currency to shore up the currency. This is more sustainable way. If we are able to bring in more, export more, we'll be able to bring in more foreign currency. And that means that the supply will always be enough to meet whatever demand pressures that we have. The other thing is about the central bank. The central bank manages the short-run deviations, okay, not this long-run supply. The central bank must ensure that it becomes more preemptive, it becomes more forward-looking, it becomes more proactive in terms of its intervention in the exchange market. Because more often than not, it looks like the central bank is taking unawares. Before we knew, the CD has depreciated so fast that by the time the central bank intervenes, a significant value has already been lost, and it is difficult for you to restore it back to the original level. So in such a situation, the central bank must always be able to project the market conditions in the next 2 months, in the next 3 months, and know when to intervene and how and when to intervene. It is critical to ensuring that it's always have enough stability. And that will also mean that its ability to be able to do that is the central banks having enough reserve buffers.
Okay.
Enough reserve buffers. If it doesn't have enough reserve buffers, although it might foresee the problem, it will not be able to intervene. So the central bank must build significant buffers, reserve buffers, international reserves, to be able to, at any point in time, intervene at appropriate time and ensure stability of the currency. So more or less, I think we should move away from a full-fledged, flexible exchange regime to a more managed, managed floating, so to speak, regime, so that to a large extent we are allowing the demand and supply to dictate the price, but to a greater extent the central bank comes in to ensure that it doesn't go beyond certain band, so that it oscillates within certain a band that is manageable, that is consistent with the inflation targeting framework. I think that is better. So we need to have a good management. We need to be able to, ensure that the speculative attacks on the currency is reduced significantly, because, beyond what the central bank can do, beyond what even exports can do, if people speculate so much on the CD, the demand pressures will always be high. And that will constantly put pressure on the central bank to intervene. And once we are not getting enough reserves or revenue from export, then the central bank will always be constrained to intervene. So the public must look within taste and preferences. We have to like what we produce here and reduce imports, so that we will always not put too much pressure on the currency. Yes, because it's key. If we want to ensure macroeconomic stability, then we must win the war against volatility in the foreign currency.
Prof, this is a question I need to ask out of curiosity again. And as a former student of the economics department, I'm sure you can't forgive me for asking this question, but I also ask for a particular view of mine. The depreciation keeps on going, so from 3 to 4 to 5, now they are saying 6. A view of mine asks, when can we go back from 5 to 4 to 3 to 2 to 1 on 1? Would that ever happen in this lifetime?
It can't happen. And even if it can, it will not be good for the economy.
Why?
It won't be good for the economy because, you are buying at the same time you are selling. When you export, you sell, right? When you import, you are buying. When the CD appreciates, it is good for you to buy. That is for you to import. Okay. But it will not be good for you to export. Okay. Because once the CD depreciates, okay, or when it appreciates, it makes the export price more expensive. Okay. And therefore, you are likely to lose your customers. People who buy from you, they will go to your competitors, which means that you will not be able to export. And when you are not able to export, the foreign currency will not come in. You'll not be able to create employment for your people, which is not good. And you will be able to rather import more, which deteriorates your balance of payments. So appreciation is not good. Okay. Neither depreciation. Depreciation, of course, will cause you make your export more competitive. You'll be able to export more, but it will not augur well for your imports. And it will increase your prices. So you also not want that. So in exchange rate management, what is important is the stability of the currency.
Okay, good one. Let's move on to fiscal policy, an area you seem to over-enjoy. Let me pick something from the report, and it says, we expect the government to continue to pursue an expansionary fiscal policy ahead of the 2020 election as it seeks to boost economic growth and as spending is not constrained by adherence to an IMF program before financing constraints necessitate a shift to a contractionary policy from 2021. Prof, somebody who is not informed reading this will say, okay, expansionary fiscal policy, we are going to spend more. IMF is not there to check us anymore. We are going to go on a spending spree, again, as has been done previous election years. What do you have to say about this?
Well, that's quite scary, and I just hope that this will not come to pass because of historical antecedents, experience from the past, I mean, where we seem to have these excessive expenditures and off-budget expenditures during election year, which have often, thrown the macroeconomic gain out of gear and, reverse every gains that we have had, which then had meant that we have to go to the IMF for much more austerity measures, fiscal consolidation measures, which tend to hurt the growth levers of the economy. So I wish that we don't go there, and I hope we will not go there. Well, my hope is based on the fact that this current government has done quite well of rolling out certain key institutions, policy framework that tend to constrain or restrain it from excessively spending. With the Public Financial Management Act, which also regulates government behavior in terms of the fiscal management, with the Fiscal Responsibility Act, which actually put a cap of 5% on government year, that's a fiscal deficit that they can record. And so therefore there's some restraint. And so the two regimes are not the same. In the past we didn't have that. Of course, even last year we have the IMF, that is 2016, but yet we were still able to overspend. So it will require a very disciplined government, because all over the world we've seen this, the political, budget cycle, business cycle, where government tend to be more expansionary, during election years, because there's often much more pressure on government to spend to meet certain infrastructure, needs. So that temptation is there for government to spend more. And if government doesn't take care, it will spend more because of the pressure, the enormous pressure that will come upon it during an election year. Because, of course, we have huge infrastructure gap, and everybody, want the roads to be fixed, want the healthcare to be improved, and all of that. But I want the government to be very mindful of that, because sometimes it may not be intended, particularly if you keep to your expenditure plan when your revenue is not or is underperforming. Then you realize that although you are within your expenditure plan, but at the end of the day, you have recorded significant, fiscal deficit. So what the government have to do, ensuring fiscal expenditure controls and matching expenditure with revenue is key, particularly in an election year, that you don't yield to every pressure that comes to you. You don't excessively spend. You don't do off-budget expenditure. Whatever be the case, you spend within your budget. And you don't only spend within your budget, you spend to match your revenue. Because if you only focus on expenditure without looking at your revenue, you find out that, of course, you are meeting your expenditure targets, but revenue will be, declining. And so in the end, you will see a much larger gap, or deficit. So you have to make sure that at every point in time, you are looking at your revenue. To avoid that is to making sure that within this period, so the time of election, you have a very aggressive strategy to drive your revenue growth, to increase mobilization of revenue so that you'll be able to match your expected increase expenditure. Otherwise, it is really going to be difficult for government to meet the fiscal targets that I've set.
On the revenue front, and the report actually starts with, on the revenue front, the government has sought to strengthen the tax regime, digitize tax payment systems, and build the capacity of local governments to collect taxes. However, enforcement remains an issue, and many companies continue to benefit from various loopholes and exemptions. Prof, you made a very telling point about matching the revenue with your expenditure. Here, they're telling us that enforcement remains an issue. And I don't think anybody, not to downplay them, has to come and tell us that it's an issue. We know on the ground that it's an issue. How do we, you've said yes, we should outline some strategies. But how do we aggressively do this and not end up where we did in previous election years?
Yeah, so it's about revenue collection, Of course, as the report said, there have been very good revenue administration, policies that have been rolled out, compliant policies to try to increase compliance on tax payments, the digitization efforts to try to reduce the bottlenecks in tax payments. All of that are intended to increase tax yield, to increase tax revenue. But, these measures, as much as they are good measures, often it takes time for them to significantly impact on revenue, increase revenue. And therefore, you may not immediately realize it. But there are certain things that you can do to ensure that, at least you increase the revenue inflow. One will be the blocking the loopholes in the revenue generation, the collection. Okay, enforcement, as you said, enforcement will mean that you are on the ground, okay, with the people, ensuring that you actually go to the people to collect. You are enforcing the laws, sanctioning those who avoid and those who invade tax system. Ensuring that also one of the key issues with revenue collection, particularly from the trade tax, has been exemptions. Huge exemptions regime that we have, where the volumes of imports enter into the exempts, where they are not taxed or they are zero rated tariffs. And therefore, one of the ways is to reduce the exemption regime that you have. The other ways is to look at the whole incentive structures that you have, tax incentives. Okay, here we tend to give too much tax incentive to potential businesses or businesses that have set up. Of course, tax incentive creates a competitive, it makes you more competitive in terms of your ability to attract FDI, foreign direct investment, and all of that. But you cannot overindulge in it, okay? You have to match it with your own revenue projections. So I think I like it when recently I heard that the finance minister was saying that in the 2020 elections is going to relook at some of the tax incentives.
2020 budget.
Yeah, 2020 budget. Some of the tax incentive. I think some of them are inimical. Some of them can be reduced to increase tax yield. So we need to increase effort. Across even sub-Saharan Africa, our tax efforts, is one of the lowest, significantly lower, even lower than the sub-Saharan African average, which is around 17%. Ours is about 15.8%. Okay. That is the total revenue. Tax revenue is very much lower. It's about 13% of GDP. And so we are not doing much in terms of tax collection. We tend to have a very huge informal sector. And this informal sector generates significant income, yet we are not able to collect enough. So we have to devise means of broadening the tax nest.
Okay.
We have spoken about this over and over, but many a times we don't seem to see much. I think the way to go is through digitization, digitizing tax collection within the informal sector, even through mobile payments. It's been done in places like Uganda, Tanzania, and Kenya, where people pay taxes through their mobile money. And that will reduce the cost of collecting these taxes and ensure enforcement and compliance.
Okay, this is the business edition of PM Express with me, Philip Nanfuri, and my guest, Professor Eric Osasibe. We're taking a quick break. We'll be right back. Right, welcome back from the break. This is our last segment of our discussion with Professor Eric Osasibe. He's an economist and he's a lecturer with the Economics Department, University of Ghana, Legon. We've been discussing the Economist Intelligence Unit report that focused on Ghana and made some predictions and some forecasts on our economy. We've looked at the exchange rate, we've looked at our fiscal regime, expenditure, revenue, how we can reduce expenditure, increase revenue. We've looked at our growth, depending on the oil and gas industry. We've looked at how the banking sector can work to oil the engine of growth and all that. We've come to the last leg of our discussion. Prof will have his final thoughts and comments on the report, and we'll call it a day here. So, Prof, we've looked at a lot of things. Inflation, we've looked at the exchange rate and how, and you painted a very good picture of how the exchange rate stability is fundamental to the economy and how it affects all other areas. As we wrap up, what should we look out for, regardless of the Economist Intelligence Unit, on our own as Ghanaians? What should we look out for as the year comes to an end and into 2020?
Well, I think that first, on the part of government, is for government to stay focused on ensuring fiscal discipline. Fiscal consolidation is key, particularly around this time where the pressure is high on it to deliver on certain key promises and the infrastructure, expenditures. Of course, these are legitimate costs because we still have significant infrastructure gap. And if you look at the data, infrastructure or CAPEX, capital expenditure, has been reducing and it currently stands around 1.6% of GDP, one of the lowest in recent times. And therefore, I think that government has to ensure that regardless of the pressure, maintaining macroeconomic stability should always be a priority. Shouldn't be the elections being a priority so that you yield to, people's pressure. Because at the end of the day, it will come back to hurt you. And so we have to make sure that we maintain fiscal discipline. At the same time, ensuring that we generate enough revenue, much more concrete and I often say irreversible tax measures. It shouldn't be a one-time tax measure that once it is done, you cannot repeat it. We should have a more irreversible tax measures that over a long period of time, it will be able to generate more revenue to this country. Of course, if you look at this increasing expenditure rigidities, the increasing wage bill, increasing interest payments, and then the earmark or the statutory funds. This actually reduces the flexibility of government to respond to these capital expenditures and then other contingent shocks that may come in. So government should look at that, how to reduce these rigidities in the expenditure side to try to free some resources for capital expenditure, because however that you want to look at it, that is a key growth driver. Without spending on infrastructure, you'll not be able to sustain your macroeconomy over a long period of time. And so key area will be the wage bill pressures. It's quietly, there's huge pressure on the wage bill, on compensation and the wage bill. And I think that government should work or should make sure that it does not, unduly increase the wage bill. On the side of the people, our own expectation of government, I think that we must always all work to support government to achieve this macroeconomic stability, because at the end of the day, it will help us. I think we must all manage our expectations. We must all manage the pressure that we bring to bear on government during election year, because people then begin to hold government to ransom because it's an election year. If you don't do this, we will not vote for you and all of that. I think it's not augur well for us. We must all support government to ensure that at least for once we go through this an election year unscathed, you know, in regards to macroeconomic stability.
Prof, thank you very much for that. And this has been the business edition of PM Express with me, Philip Nanfuri, and my guest, Professor Eric Osei-Asibe, economist and lecturer with the Economics Department, University of Ghana, Lagos. And we've been going through the Economist Intelligence Unit report that focused on Ghana, giving some predictions and forecasts on how developments in the economy will turn out, particularly as we head into the election year and even beyond. I want to say a big thank you for your time. Do have a good one.